Hey, do you know there are 8 optimal guidelines for dividend investors? These are ways that help make your money grow more efficiently, effectively, and safe. Today we're going to go over those guidelines. Let's go. So the first of 8 guidelines would be quality. The most common sense approach is to invest in high quality companies. So those high quality businesses have a proven track record of stability, growth, and profitability. There's not a single reason to go after something mediocre when you can have a solid foundation in a good company. So when you're looking at your stocks, you want to rank them by their dividend history and their corporate history. How well did their dividends fare during the Great Recession? Did they continue to pay dividends during the recession? Did they increase their dividends during the recession? These are good things to look at. And the evidence shows that the dividend aristocrats have outperformed the S&P 500 by 2.88 percentage points per year. And I'll put that right there on the screen. Look for bargains. You want to invest in companies that pay you the most for your dollar. The higher the dividend yield, the better. And you also want to invest in stocks who are trading at their historically low average. You don't want to overpay for your stocks. Additionally, you want to rank your stocks by dividend yield. Only those trading below their 10-year historical average should be considered. The highest yielding group of stocks outperformed the lowest yielding group of stocks by 1.76% per year from 1928 to 2013, and I'll link the source right here. Number 3 on our list is safety. How safe is our investment? If a company is paying out all of its profits in dividends, there's really no margin for safety in that company. With that type of company, if there is a business downturn, that dividend will be cut, no problem, quicker than you can blink an eye. Another risky investment would be purchasing a company that's overpriced. Something else you want to keep an eye on is if a company is repurchasing its own shares. During downturns, that company can then redivert the money once used to repurchase shares into funding its dividend, thus creating a margin of safety. On top of that margin of safety, it could also indicate that that company is undervalued. Since I'm just some rando YouTuber with no financial training, take what I say with a grain of salt. But an undervalued company might be something worth checking into. Moving on to the 4th guideline, we want to invest in companies who are growing. A growing company is a healthy company. If the company or business has maintained a high growth through several years, they are likely to continue to do so. Growing dividend stocks have outperformed stocks with unchanging dividends by 2.4% per year from 1972 to 2013. Guideline number 5, peace of mind. Today, as of filming on the 24th of February, stock prices have tumbled. The coronavirus is just completely wreaking havoc on these things. With following the guidelines, I've invested in stable companies, I've invested in growing companies, so I'm not worried. Look for businesses that people want to invest in during times of recession, panic, and downtimes. These are companies whose stock prices remain relatively unchanged, even in times like today. So in a nutshell, look at the stock's long-term volatility. Hey guys. Hey, thanks for sticking it out with me. I hope I haven't put you to sleep yet. These 8 guidelines are amazing. They help me out so much, but those first 5 that I went over, I've been reading off a script, and I feel like I'm killing my personality, and I really want to be genuine with you. And it's so hard as a new YouTuber. So let me know in the comments down below if you think these next 3 guidelines I put forth are better than the first 5, personality-wise. I really need to know, guys. Thanks. Okay, so this video is starting to get a little long, so I'm going to speed it up on these last 3 guidelines. So we're going to combine 6 and 7. Number 6 is when a stock is overpriced, when to sell, and tip number 7 is survival of the fittest. So a really good example of tip number 6, overpriced rule, is Tesla. If you bought Tesla at $100 and now it's trading at nearly $900, it might be a good time to sell, or you could hold on to it. Some people do, some people don't. It's up to you. But take those profits, reinvest it into another company, and keep those dividends growing. Number 7, survival of the fittest. If the company you're invested in begins to decrease its dividend or even cut the dividend, it's time to move on from that company. That's basically the gist of it. And finally, tip number 8, hedge your bets. Basically, in a nutshell, is be diversified. No one is right 100% of the time, and a well-diversified portfolio kind of protects you from any downturns. If one of your companies cuts a dividend, sell it off and replace it with another one, is what I would do. All right, well, that does it for me. These 8 guidelines have really helped me in my investment journey, and I hope they help you too. So if you could let me know in the comments below how my personality was in these last 3 on these last 3 guidelines, I really would love some feedback. Again, if you like the content, give me a thumbs up, like, subscribe, comment down below, and we'll see you next time. Thanks a lot.